Welcome back to Growth Without Referrals. Today, I'm joined by Ron Edmonds of Principium, White Oak. Ron has spent years advising business owners through mergers, acquisitions, and exit planning. With deep experience in industries like lawn, landscape, and home services. One thing I'm really looking forward to unpacking today is the gap between what business owners think their company is worth and what buyers are actually willing to pay. Ron, welcome to the show. Glad to have you here.
Thanks, Mark. Happy to be here.
Great. So, Ron, I'd like to start with your background. You originally grew up in Oklahoma and eventually built your career advising owners through some incredibly important moments in their businesses. What originally pulled you into this world of mergers and acquisitions?
That's a sort of interesting story. I did work in mergers and acquisitions in my time in public accounting. I spent 14 years in public accounting, and then I was a CFO of a small healthcare company that was acquisitive. So throughout my career, I had done work but when we sold the company that I worked with, I took some time to try and figure out what I wanted to do next as a third career. And I started doing a little bit of consulting, and I got a consulting gig with the largest lawn care company in the country that happened to be in my hometown. And they were, had launched onto a very strong acquisition program. They had a kind of a pivot point because prior to that time, and this was about 20 years ago, prior to that time, their primary customer lead generation tool was telemarketing. And with the no-call list, that went off the charts. And as the biggest in the industry, they didn't meet any test that allowed them to even do a little bit of telemarketing after that. And so one of the different strategies they tried was to start doing lots of acquisitions. They'd always done acquisitions, but they started doing many, many more and relatively small acquisitions. And that kind of got a little out of control, as you might expect, because they were doing about 50 a year when nobody else was doing anything like that. And I came in to try and help them give some structure to that and to look at their due diligence processes and so forth. And I really thought it was going to be a 90-day gig. And I ended up spending most of my time there for 2 or 3 years. And after getting involved with their process and how they interacted with M&A advisors and business brokers, I thought that's an interesting area. And if there's a tiny portion of the business owners that would rather deal with somebody on what I would call a more professional level than what many of the people doing that kind of work at that time were, I thought that it would be a way to make a living. So I hung out my single, focusing initially on lawn care because that's what I knew. And I quickly discovered that there wasn't enough activity to keep me going in that area back then. And so we branched out into related areas and working in the landscape space and other things related to that. We do some pest control and other home service type businesses, but the vast majority of our business over that period has been lawn care and landscaping.
Okay. And Ron, was there an aha moment early on when you realized how emotional selling a business can be?
I don't know whether there was an aha moment or not, but it was very clear to me that people were making extremely hard decisions personally when they made a decision to sell their business. And sometimes that's a decision, the first decision of whether to look for a buyer. And then sometimes people have a hard time at the very end after they've gone through a process and have a buyer that meets their needs. They still have trouble pulling the trigger because it's so emotional on them. And sometimes they can't imagine what life would be like without the business that they built from scratch. Their baby.
Okay. And Ron, one thing we discussed in our earlier conversation was value creation and readiness for selling. From your experience, what do business owners most commonly misunderstand about preparing for a successful exit?
For the most part, many business owners don't really understand anything about it. And in the current time, there's a lot of activity in these areas. There's all sorts of roll-up activity. And people assume, based upon what other people experience, an idea of what their business is worth. Now, the problem with that is the other people might not be telling the truth. They're making the assumption that their business has the same characteristics that drove the value for the other company. And that's often just not true at all. Uh, and so they have a lot of times have to be coached to understand the issues that most affect the value.
And do you find owners usually start preparing too late?
I have a great response to that question. Yeah, it's not uncommon for me to get a message or a call from someone that says they want to begin thinking about exit planning for their business. The problem is that after I talk with them for a while and get to know them, 75% of the people that call like that, what they really mean is, I want to sell my business as fast as I can sell it. I'm done. And so they haven't really thought about it, but there's no doubt that those that pay attention to it and have a plan and execute on the plan to get where they want to be are going to have a much better result. And, I've
Sure.
had people that I worked with over a 10-year period. I didn't always know exactly what I was doing, in the sense that they would want to meet, other people would want to meet with me every year at a trade conference and talk about what they were doing in their business. And then after talking to them over a long period of time and seeing them grow, they say, well, the time is now. Let's go.
Okay. And what are buyers looking for today that owners often underestimate?
I think that a lot of times owners don't understand, and it sort of seems obvious, that a buyer is interested in the cash flow from that business. And the expected cash flow from the business is going to drive value. And, most people talk nowadays in terms of EBITDA. That's not the whole story, of course. But I have clients or people in the industry that ask me, well, what EBITDA is important? Is it the trailing 12 months? Is it last year? Is it the last 3 years averaged? And I said, well, different buyers handle things differently, but what's most important to them is next year's EBITDA. And how value really happens is being able to demonstrate that what the business you've built will deliver cash flow next year, the year after that, and so forth. And that is really the essence of what they need to do to make sure they build value in their business.
Okay. Ron, do you find that companies heavily dependent on referrals sometimes struggle more with valuation because growth feels less predictable to buyers?
I think that's true. A lot of times we would cast that as reliance on the owner or a key employee that has the referral relationship. And that is a big red flag to buyers. You more or less in the home service areas anyway, the highest value businesses are ones that have recurring revenue that doesn't require additional selling to speak of, except for growth. And so not only does it not require referral, but it doesn't require the selling. But relying on relationships that drive referrals, and just talking to you, I realize that it's interesting. We talk a lot about reliance on the owner or a key employee or a concentration in customers, but you may have reliance on referral sources that you don't even understand. They just happen. People call it word of mouth, but those are referrals, and we don't. How do you sell that relationship?
Okay. And Ron, that actually ties perfectly into the theme of this podcast. A lot of businesses grow through reputation and relationships, which is great. But eventually, buyers start asking, can this company grow predictably beyond the founder's network? How do you think sophisticated buyers evaluate growth systems today?
I don't think there's one answer to that question. They look at what's really happening in the business. Is the owner super involved with everything, or does it happen without him? What kind of systems have they generated? In the home service area, we find that those are often very conducive to consumer marketing, which isn't relying on people individually. We do work in commercial services, and that's not really the same beast. But there's a playbook that may be different for different sectors. But for example, in lawn care, there's a pretty defined playbook, and there are people that have a very good handle on what consumer marketing is successful, what mix of digital and other marketing systems will produce an optimal result. And it's pretty amazing what the people that are experts in that area can do, because they can look at a market and a product line, a service line, and in ad spend or marketing spend, and they can tell you when to stop spending money that you're not going to get any more value out of it, for example. But they can definitely guide you to doing that in a way that generates customer leads. And then, your problem is to what do you do to convert those leads to customer?
Yes. And Ron, it sounds like predictability becomes extremely valuable during acquisitions. Ron, you spent a lot of time in the lawn and landscape industry specifically, and that industry has changed dramatically over the last several years.
Absolutely.
Has private equity become so interested in these businesses?
I think fundamentally predictability, or the ability to make them predictable. And when I make that nuance there, I think there are a lot of these businesses that have not invested in systems that are effective. And the private equity buyers know that you can take that base and apply more professional techniques and drive value even more. Now, I'm not going to tell you they look for the lousy companies, but they don't necessarily hate them. They usually get them at a good price because they haven't already
Sure.
done it. And so those sellers have left money on the table by not investing in better processes.
What separates highly valuable operators from average operators?
There are a lot of things, but a willingness to learn and ask questions and to listen to other people is probably the best characteristic. For example, it is just really, really hard for a business owner to evaluate their own business and whether they're doing a good job and whether they've created value. But one of the things people do, and we encourage, and there are many peer group operations within these sectors. And in a peer group, a business owner signs up for a group that is composed of similar business owners of similar sized businesses in a non-competitive location. So a lot of times they'll be from all over the country, but they'll have the chance to talk with and interact with what quickly become friends who've gone through the same issues they're going through, and are able to take a more neutral look at how a business is operating and whether there are opportunities to grow and increase value. So a lot of people have done that and had unbelievable results. Now they've got to be willing to listen to the other people and not think they're the smartest guy in the room. And that's a problem for a lot of people, because a lot of people have become successful by focusing on what works for them, and they don't necessarily recognize the difference between what's worked for them and what would work for somebody else and be attractive.
Okay. So let's say a business owner listening today wants to eventually sell their company at a premium valuation. What are the biggest things they should focus on now, even if they're years away from selling? Is it leadership depth, reoccurring revenue, customer concentration, predictable lead generation? What would you say, Ron?
I think far and away, number one is leadership. And when I say that, I mean really having a team that can not be totally reliant on you. Probably that in most cases, that means having a clear number two in the organization that can act in your absence. Now, that's easier said than done. You can say you want to do that, but will you operate that way once you hire somebody that has the right characteristics? Traditionally, we encourage them to test it out by going on vacation, for example.
Yeah.
And because a lot of business owners, may not take very many vacations. When they do, they may feel like they have to call into the office every day. And that's usually because they haven't empowered anyone else to make a decision in their organization. And that one thing will typically or quite often unleash all kinds of good things within the company. People become more creative when they're not taking the easy way of having you make the decision, and they figure it out. Some of them grow into being the good leaders for the business going forward. Now, those other things you listed are terribly important too, but in terms of getting on a process to build value, I think that's, to me, that's number one.
And thank you for that perspective, Ron. I think that's spot on. And Ron, I think a lot of people underestimate how emotional selling a business can be. You're often talking about someone's life work. How do you help owners navigate the emotional side of the process?
Well, that's a complicated process and one that we don't always do the best job with. I'll tell a story before we're through with this. We do try to talk to potential business sellers early in the process about what is it they're trying to accomplish and what are they going to do next? Are they going to be in the business? Or are they not going to be in the business? If they're going to still be in the business with a new owner, I ask them the question, are you sure that you're going to be able to fill out an expense report for somebody else? Because you haven't done that in 30 years. You have to get your mindset right if that's what you're going to do. But beyond that, the most unhappy people after a business sale are ones that haven't got a plan for what they're going to do or are very vague. So they literally get up in the morning and don't know what they're going to do. And that doesn't work very well. That's not the right time to start exploring what your interests are. You ought to be doing that long before so that you already know what it is you'd like to do. If it's in retirement, or if it's moving towards some other business operation or some that you've actually given it some serious thought. When I said I was going to tell a story, I had a client a couple of years ago who was one of these people I'd actually talked to for years, known him for, I guess, at least 6 or 7 years, and he was relatively young for selling his business. He was actually under 50, but he was one of these people that he's financially literate and knew what it would cost to live on without working, and had calculated that down. And he actually sent me an email just before he signed an agreement with us saying, Ron, before I sign this agreement, I want to make sure you understand that I have to get X amount of money from the sale in order for this to work. And if I don't get to that point, then I'm not going to take the deal, no matter how good a buyer it is. It has to be that level. And I was pretty comfortable in that case that we would get there. I didn't know what would really happen was that we were able to generate a lot of interest in this business and some competition among buyers, and we produced an offer for him that was roughly twice what he said. And as we were going through the due diligence process, and it went pretty well. The reason that it went well was because he had a well-prepared business. But he called me one day. He said, I don't think I can do it. And I was in shock, to be honest, because we'd really done a good job at this project. Got him more than he ever dreamed he would have gotten, but he was having a really hard time signing on the dotted line. And I mean, at that point, the agreement was just about finished, and then he came back on board, and we finalized the agreement pretty much, and we're probably 20 days before closing, maybe, and it came up again, and he just literally made himself sick from it, and he went off grid from the deal for a month. And I was sure that the private equity firm that was going to buy this business was going to walk away and not re-engage because they wouldn't want to throw good money after bad, knowing that he was so indecisive. But I talked to him. In this particular case, I wrote him several letters. He'll probably hear this, so I have to be careful. I wrote him letters because I was hoping that he would print them out and leave them on the coffee table at home for his wife to read as part of it. Well, I can't promise you that when you think you're beginning to think maybe you'd rather do it in 3 years. I can't promise you we can produce this result in 3 years. Maybe, but You've got it now, and this was your goal. Ultimately, he came through, but he really had a hard time with the idea of separating himself from the business. He'd very successfully grown. He had had a great program, executed all these steps along the way, all toward his goal of being able to do this. But when it came down to it, it just tore him up.
Well, a great story that kind of illustrates sometimes the emotions that are involved in these cells, right? So,
Absolutely.
Ron, looking ahead over the next few years, how is technology changing the acquisition process?
Well, it's already changed the acquisition process a lot, before we even start talking about uh, AI and different things like that. I think back to, the technology had grown. But COVID is one of the things that changed the acquisition process dramatically because while Zoom and these systems existed, hardly anyone used them. They joked about hating them, and then all of a sudden we're in COVID, and that's the only way we could communicate. Before COVID, people like me were on the road all the time. Uh, they wanted, and when the due diligence process was very people intensive on site, made it hard for confidentiality to be maintained. I remember I had a transaction um, 10 years ago where it was a little bit complicated, but not that complicated. And in most cases, the buyers have a pretty broad team of consultants or in-house people to work on due diligence. But I want to say they rented out half of a Hampton Inn and would run people back and forth to the office and then go over at night when the employees weren't there as if no one would notice that something was going on. And we never do that anymore. Everything that can be done remotely is done remotely. The buyers will go and meet the needed people and look at the equipment and the facilities and so forth. But beyond that, there's no need for having 20 people go on the road to handle it. And the whole processes of due diligence have gotten much more automated. I think that in most sectors, there are high quality systems nowadays that if a seller is on an industry standard CRM type system, it's much easier for a buyer to look at the data and make an evaluation and put it through their systems. Just an insignificant level to the process, I'll say that, you know, 50% of the $10 million businesses that we deal with, at least 50% use QuickBooks for their basic accounting functions. And, you know, 5 years ago, they would be asked to do a backup of all this data and send a
Mm.
CD to the firm doing a quality of earnings review and all that. And now almost all of them have remote access available. And, and we used to get a list of 30 reports or 50 reports that the buyers or the buyers' accountants wanted to have run, and we don't do any of that now. We give them access to the data online, and they suck it out and do whatever it is they do with it. And so those things have already significantly impacted. I don't even know, certainly AI application in every field is the hot topic now. I can go to a lot of industry conferences over the years. It used to be everybody had to have a session at every conference on marketing to cohorts of age cohorts, and this is how you market to millenniums, and all this kind of stuff. And now every single conference has you know AI. So I have go to conferences they have application of M&A of AI. I go to conferences for the industry, and they have sessions on how to use AI in lawn and landscape companies. So the change is happening pretty fast, sort of. I think the adoption, there are a big difference between the current adopters and those that wait to get involved with that.
Mm.
And it's a natural tendency of people to not make changes in their business as they are getting toward the latter stages of their perceived period of ownership. That's probably a mistake. I mean, certainly people have to worry about making investments they can't recover, but being up to speed in the industry it's pretty important. And the speed by which some things can be done now is pretty amazing. But I think that will only become much more significant over the next few years, and probably shorter end of the few years. Really, is things are happening pretty fast. I don't think that's a too big
Absolutely.
response.
It's true. And Ron, this has been a fantastic conversation. And thank you for joining us today. For listeners who want to learn more about you and your company, what's the best way for them to connect with you?
Well, our website is principium-whiteoak.com, and you can find our email address there, or maybe we can get the email address in the notes for this. But we welcome talking to you about your business, and no commitment, just to talk, because we find that's how we develop our pipeline of clients into the future. And beyond that, we just like talking to people and seeing how different people approach the issues in their business and seeing if we can help.
Okay. And that's correct, Ron. I will put your contact information in the notes and description of this podcast so people will be able to find you there.
That's really important, since my website is so hard to spell. So I really
No worries. And thanks again for being here, Ron. And thanks everyone for listening to Growth Without Referrals. We'll see you next time.